I get a feeling this year, Kawaljeet, that IT companies will not get a reason to smile at all. They'll only be saying we don't know, uncertainty, impact of tariff. First, they had a reason called AI not to give a concrete guidance. Now they have two. So what should we hear from IT companies? Nothing whatsoever and no reason to smile?
So are you giving your view or are you asking a question,
No,
Nikunj?
I'm just asking a question. Is my view right?
Okay. Look, I think what we are in a tough spot here because the environment is a lot has changed since April 2nd, and how do you encapsulate that? When they report their earnings, will be a fairly tricky one, yeah. So you would hear a lot from them, but with caveats, yeah. So yeah, you're right on that count.
But Kawaljeet, help us understand that what could be the likely impact on the Indian IT space if the fear about recession actually comes into true color, because we have seen a lot of uncertainty back in 2008, and well, of course, the recession was true at that point in time. But this time, with the fears around, how is it different in 2025 versus 2008? Any lines that we can draw here?
Okay, see if the recession were to happen this time around, and that's a big if, but let's say if there was a recession, the first thing is that we are still in the midst of a massive tech upgrade cycle. So your tech spending intensity would continue as compared to what you saw in 2008, when the tech spending intensity went down post global financial crisis. The second big difference, let's say if the recession was to happen now, is that what happens to currency, because back in 2008 there was a lot of pricing pressure from clients, but that got offset by the fact that the currency depreciated. We don't know whether currency would provide that profitability tailwind this time around as compared to what you saw in 2008. The third big difference is that the recession, if it were to happen, the impacted sectors would be different. The impacted sectors this time around would be, let's say, your manufacturing, retail versus what you saw, which was financial services back then. And the fourth big difference is that the set of competitors which is vying for the overall tech pie is fairly high. Remember, this time around there are hyperscalers, which actually are very competitive, and they will continue to capture greater and greater portion of tech spending. You have software companies which have moved from a perpetual license sale to as a service construct. So the flexibility which an organization has in a downturn to, let's say, extract, let's say, better terms with clients has gone away because of the as a service construct of clients. So as a result, what you may have is that the pressure, let's say, to deliver savings to customers on budgets would increase on services. So this time around, maybe the pricing pressure would be there on services. Yeah. So there are a lot of differences, overall. But the thing is that the pricing pressure and profitability would be the key thing to watch out for in case a current recession does play out. Yeah.
Scenario, Kawaljeet, do you think there are going to be any winners or resilient movers within IT pack, or do you think it's going to be a collateral damage that one is bound to see?
I mean, let's say if there were to be a recession, then everyone gets impacted. Maybe TCS will get less impacted versus others, given their nice balance of revenues between discretionary and managed services as such. But really, I think if there was a recession, everyone gets impacted. Yeah.
IT, it's not the first time that IT is falling. We've seen IT take it on the chin pretty much from the start of the year onwards, if not a little before. There is concern around the ongoing tech upgrade cycle, the increase in AI adoption, and how these service providers can really adopt to that, and how quickly do they transition. But the bigger challenge right now is, I think, around discretionary spend. How resilient do you think IT companies would remain if indeed there's not a recession, but a at-large slowdown in spends emerging from the US?
I guess the markets and the stock prices are already building in a slowdown. So let's say if it was just a slowdown, I think the stock should be fine. Even in our own estimates, when you look at FY26, we have built in a 2 to 4% or rather 0 to 4% revenue growth for tier one IT companies. Yeah. So if there was a slowdown, I think a lot of it is already in the price. And actually, you would see in the next 6 months, nice recovery and money to be made in the sector as such. The key risk is, of course, the recession, in which case the downsides open up.
Money to be made in next 6 months, is it largely because the next 6 months the base effect would start kicking in? I mean, this year is, if it is bad and last year was okay, then 6 months the base effect kicks in and then markets will start re-examining it?
No, I think let's say if it's a slowdown and not a recession, what you would have is maybe a quarter or two of impact. And I think, actually, let's step back a little bit, right? Right now, there's uncertainty. So clients may hold back spending, they may hold back projects, programs, but if there's certainty that, okay, there's a particular direction in which the business is moving, then automatically a lot of the spends and programs which are put on hold automatically get released, and that's flowing into the numbers. And automatically, as the numbers come in, the stocks would reflect that improvement underlying reality.
Now, let's look at IT in terms of categorization. Should one now start looking at, let's say, an HCL Tech more because it's Europe more? Should one start looking at Tech Mahindra more because it is telecom more? I mean, is it time to start looking that kind of in categorization within categorization to find the winner and the laggard?
Hey, I think you have to basically divide the sector, into first of all a view. If you are into a recession, then of course you have TCS that will hold up well amongst all these names. Let's say if you are looking at recovery, then you end up with Infosys. So if you have to basically make a split on the sector, there are two cuts that you can adopt. One is the percentage exposure to manufacturing plus retail as a bucket. And that will be the bucket which will be immediately the most impacted. And then you have to put in a cut of discretionary versus non-discretionary spending, or composition of revenues from discretionary versus non-discretionary. So if you take this particular cut, then TCS has the lowest exposure to manufacturing, a relatively high exposure to retail, moderate exposure to, let's say, discretionary. So that seems to be the best positioned. The companies that have a high exposure to manufacturing plus retail combination are Infosys, HCL Tech, Tech Mahindra, and LTIMindtree, right? So they would be the most impacted. Now, if you basically delayer it further within this particular segment, Infosys has the highest discretionary exposure as such. So I think this is the framework to adopt, which is manufacturing plus retail on one axis, and discretionary versus non-discretionary. The third, of course, you can always put US versus Europe, but I think if the US is in a recession, then I don't know, what could be the implications for Europe in the process.
Kawaljeet, what happens to the slightly isolated or niche plays, the likes of a Persistent or a KPIT, which have not been trading at the same PE multiples as the rest of the pure play services providers and haven't fallen a whole lot in the correction that the rest of the IT pack faced?
I mean, KPITC, it's got a direct auto exposure, and auto is in the midst of the storm, so it's vulnerable from that vantage point. Persistent, yeah, actually, their portfolio in the current environment looks all right. Though, of course, the stock is expensive, so which is why we have a sell. So it may meet a lot of the criteria, but if it's expensive, then how do you make money, right? So we are cautious on both.
What is the deserving P multiple for IT? I mean, if one has to, let's say, look at for FY26 and 27, I mean, analysts would always say, iske upar cheap hai, iske upar buy hai, iske upar sell hai. What is that yardstick to judge that IT is expensive, fairly priced, or cheap?
Let me just give you a simple framework for that, Yanikunj. Let's say if you assume a particular stock, okay, let's say there's a stock in which you hit a terminal year right from the current year itself. So let's assume that the growth rate on a long-term sustainable basis is 3% in dollar terms here. You assume a 2% rupee depreciation, so you get to 5% kind of a sustainable growth. 10.5% cost of equity, you get to 17 to 18 times as the multiple, in assuming that these companies hit a terminal year right from FY 26 itself. Now let's look at it a little bit more medium term. I think some of these companies can definitely grow faster than that 3%. Many of them can grow by around 6 to 7% over a period of next year. If you take that assumption, then the multiple goes up all the way up to 23 to 25 times here. So if you're looking at the range, at the trough, right, around 18 times, I think for Infi and TCS, I don't think the stock should go below that. And at the upper end of the spectrum, you would have around 25 times. I think that's the range to look at. And after that, you basically weigh in the probability of a recession or a no recession. And I think that's how you'll come out with the recommendations here.
All right. Kawaljeet, appreciate your time. So glad you could join us.
If you like this video, then like, share and subscribe to ET Now.